All attendees are in listen-only mode.
G'day everybody, welcome to the Ask the Expert webinar for the 19th of March, and apologies for the lack of webinar last Monday, but some personal circumstances just got in the way. But anyway, we're back this week. Now just a little bit of humour to start with, as I like to do all the time, and I guess you've all read of late about the things that an ex-senior Goldman Sachs employee has revealed to the New York Times about how Goldman Sachs treat their clients, and Goldman's are protesting loudly, but I think it's there's probably a pretty fair element of truth in that, and it really isn't a level playing field. And if you've been in the financial markets for very long, I think you'll realise that it isn't a level playing field in lots and lots of ways. That's okay as long as we recognise that, and we don't we don't think that it's all fair, because it's not, and that means that we need to be extra careful to make sure that we've got an edge on the market as well, because there are things that we can do that give ourselves a distinct edge. So I think it's just always really important to remind ourselves of that. Now, the information that I'm going through in everything that we do is general advice only. Obviously, we don't know the personal circumstances even of our members, and we don't necessarily know their objectives. So everything we do is general advice, and in this particular forum, which is open to the public, it's even more so, and there are even more handcuffs that I've got in terms of what I can say and what I can do. So just a reminder, this is general advice. Anything that I say that you might think you could use to advantage tomorrow, you've got to remember that that statement's being made without any knowledge of your circumstances. So just a little bit of housekeeping, just the realities of compliance. Even when I'm giving general advice to members, so that is information that is of a general nature only, they still have to have been given access to the Financial Services Guide, and potentially have been able to ask any questions on that. Now, in this case, we obviously can't distribute a Financial Services Guide to certainly part of the audience tonight. So again, that just limits what I can say, but within those bounds, I'm obviously trying to provide as much value as I can. Now, there are quite a few new people that have joined us tonight for the first time, so welcome to everyone. And I just want to quickly cover the purpose and the scope of what I'm doing in these webinars. The purpose is really to provide an opportunity for you to gain a perspective on the current global setup. So we're really talking about the major markets, gold, silver, oil, all those sort of things, so that you've got a basic general backdrop that you can perhaps make some decisions about. It's also going to give you an opportunity to learn some of the key general principles of successful trading and investing. So I'd really encourage you to ask questions along those lines about how you can, what avenues you've got at your disposal to use to be a more successful trader or investor. I've got a lot of experience in the market. It's more than a couple of decades now, and I've been through everything. I started my trading just prior to the crash in '87, and got properly sorted out in that situation because I had no idea what I was doing. So I've been through a lot of things. I've seen a lot of things, and I've got I think a pretty valuable insight on the market and how it operates. And also the purpose of this, I guess, if you want to be a regular participant in this, is just to allow you to assess the methods that I use and how I approach the market in general terms. And I think that's perhaps beneficial. Now, the scope of what I can talk about within the bounds of the financial services laws, I can discuss major market trends. I can obviously talk about the big picture drivers. I can't provide an opinion on specific stock entries or exits, because that obviously is not only general advice, but it's perhaps getting into personal advice as well, which is a real no-no. And obviously I'm not in a position to divulge the information that our members pay for on a monthly basis. So hopefully that's all good for everybody. Now, just a couple of quick words on my methodology, because I've had a few questions of late, particularly from traders outside of our membership, with respect to how do I use charting and how do I use fundamental analysis in what I do. I want to make it really, really clear a couple of points. Firstly, that any technique that you use is only relevant if you're looking at the whole picture. So that's fundamentals, it's charting, if it's charting, it's looking at the whole picture of entries and exits and risk management and all that sort of thing. So you shouldn't ever read anything in isolation. And this is the really key point I want to get across, is it's not the information that you might get that's important, but it's what you do with it. And probably the best example is, we're all human and we all like to get stock tips and all that sort of thing, and we think that we've got something of incredible value. But in actual fact, getting a stock tip here and there is actually not that helpful, because you don't know anything about what would be a good entry price, what would be a good exit price, how would I manage my risk. So that's on an individual trade basis. And then, of course, over time, the most important thing is that you need support. And so you need to be able to do things consistently, and that requires a high level of support. So there are a couple of points that I always make really clearly. Now, looking at fundamentals, it absolutely has a place, and I think a few people I've been conversing with of late have the impression that I'm purely a chartist. That is absolutely incorrect. I do a great deal of fundamental research, and I use it a lot. I'm doing fundamental research every day. Now, I don't always use it in particularly my shorter term trading, but I would always have a pretty good bias towards using fundamentals. Fundamentals will tend to play out with relevance over time. If you're doing very short-term cash flow trading, so we're talking about a few days to a few weeks, then to me, doing good fundamental analysis has far less meaning, because the market can do something completely different. You can have the greatest stock in the world, the greatest story in the world, and it just does not translate through to price action in your favor within that time frame. Give it enough time, then it probably will, but it's still not a given. And I think some people see a good story as inevitably playing out in the market, and I can assure you that I've been burnt many times on making that assumption, because there is often material which is not publicly available which is influencing the share price. And if you're just working off publicly available information, which is what 99% of people can do, then you can't be sure that there isn't some stuff that you don't know, that you're not factoring in. Now let's have a look at charting. Charting unquestionably tells you what has happened, and it's telling you what is happening right now. So we can look at price candles, we can look at volume, we can look at some indicators, and we can see what is happening right now. In no way would I ever say that charting will tell you what will happen in the future. Absolutely no way. It just tells me what is probable based on buying and selling momentum and crowd behavior. And for those that want to state that charting is just a bit of voodoo black magic, clearly they do not understand how to read crowd behavior and how to use charts to advantage. So I'll just leave it at that. But I want to make very, very clear that I use charting a lot. I would always use charting even with fundamentals. For me, not looking at a price chart before I did a transaction would be like going out of a morning without my undies. It would feel dead uncomfortable. So I will always use a chart, but I'm absolutely a fundamentalist as well. So charting, it's of great value, but it doesn't tell you what will happen for sure. It just gives you an edge. Now, I'll move on with just a quick presentation, and then I'll get to your questions. So just a quick global recap. The S&P 500, to my mind, is still defying the odds. We really should have had a correction of a bit more substance by now, but we haven't, and it's been an impressive rally. And the odds are that it will probably keep going for a bit longer yet, possibly, quite a bit longer, with a few ups and downs. Now, at this point in time, it's overbought technically. It's overbought on a whole range of contrarian sentiment indicators as well. But the reality is it still keeps going up. But I think you should take a prudent stance and expect a pullback between where we are now, which is just a bit over 1,400 points on the S&P, and the next resistance level that I've got at 1,440. And what I'd suggest is that at least we'll probably get a little correction, maybe like what we saw a week or so ago when the S&P fell about 24, 25 points in the one night. So it may just be something as minor as that, but it really would be prudent to expect that. Now, if it doesn't happen, fantastic. You've still got some exposure. You're still able to participate. But, you know, please don't assume this market's going to continue just to power on going higher day after day after day, because markets just aren't like that. Now, from my perspective, kind of reading the fundamentals and the sentiment around the world with all the information that I chew through each day, to me, the threat of a financial meltdown in Europe is off the agenda. People are pretty relaxed about that now. Fund flows into US mutual funds in the second half of last year were basically going outwards. So in other words, people were pulling money out of mutual funds in the US. They were putting money into basically the bond market, where they were prepared to accept just a stupid return on interest. In fact, it was probably negative in terms of real inflation. And that money was essentially scared money that was hiding, because people were more worried about getting their capital back than about the return they got on their capital. My understanding is that those fund flows have now reversed and money is now coming back into the mutual fund industry. That means that there's going to be a massive amount of money that the mutual funds are now going to have to go into the stock market to buy stocks, because they can't just accept that cash and then do nothing with it. So that's a reason why I think on a slightly bigger picture view, I still see the next few months and most of 2012 as being pretty positive. So I'm pretty bullish on the market. I'm just apprehensive in the short term because this has been such an amazing run. And I think the other thing too is that there is an expectation that money printing is going to happen whenever it's needed. The ECB, England, Japan, America, whenever they need it, they're going to turn the taps on. And I think that means that markets have really got over that fear that we saw in the second half of last year. So a really interesting question is, how will a correction in the US impact our small cap stocks? That depends a lot on what happens with commodities, because I guess most small caps that we're trading in at the moment are resource-based small caps. And so it does depend a hell of a lot on what happens to commodities, which depends on, of course, partly to a degree, the US dollar. If the US dollar goes up, then we'll see commodities come off, and that will affect the stocks to a greater extent. Also, it depends a bit on China. Now, there's been some apprehension about China. My view is I think we're going to see too much of an untidy nature this year. Yes, China's got some issues, but I'm basically a 10 to 20 year China bull. I believe that they're going to sustain what's going on in the commodity market for a long period of time. So I think the impact on our small caps, if you got a sudden 50, 60 point drop in the US market, then there will be a significant impact on our small caps, and you'll see some of the real penny dreadfuls. They could lose 20, 30, 40% on opening, and you know, that much over a period of a few days. So again, just a reason to be careful. Make sure you're taking profits and you're getting good entries. Now, the ASX still lagging significantly. Business and consumer confidence in Australia is grim. I think that is unjustified. I don't think we're going that badly. And it's getting worse despite the reality. So it's becoming a bit of a self-fulfilling situation that because business and consumers are thinking in a kind of a negative kind of pattern, that's actually affecting their decisions of spending and investing. So that's not particularly positive, and yeah, we'll just have to see how that plays out. the high Aussie dollar is an issue for the large caps, no question about it, and I think because of that we're probably not going to see our index do a whole lot different from what it's done. We're probably not going to see the banks and BHP and those entities doing a whole lot more than what they've been doing recently, which is basically just bobbing up and down in a trading range. There's the political agenda, of course, which is also turning off many overseas investors. So the small caps is where it's at, but it's still absolutely a stock picker's market. I would have to go through 500 small cap charts a day, and I've got to say that whilst there's some great breakouts, there's a lot of breakouts, this is a buoyant period, that the percentage of stocks that actually follow through and end up being a good trade is still relatively small. So this is still very much a stock picker's market. It's not one of those wild markets where just everything goes up together. So therefore entries and exit techniques become even more critical, and as the market moves higher you've got more and more profit baked into the cake, and therefore it's more and more important to just take a little bit more care. So I'd really encourage you to turn your cash flow over, take profits out of stocks and put them into other stocks that haven't perhaps moved as far, that are just starting their moves now. And I was having a discussion with someone today, and I was just saying I always look at where I've got my money. Is that the most productive place for me? Is there likely to be more upside in that stock, or is there likely to be more upside relative to the risk in some other stock? And that's kind of how I evaluate things. Now looking at gold, and we will have a look at these charts in just a minute. Gold is kind of fooling people a little bit now, and to my mind it is still in this corrective second leg. It's taking agonizingly longer than any of us would like, but I still don't see that anything has basically changed in the pattern, and that we're looking for significantly higher prices in gold throughout this year. I believe that the bottom may be fairly close, because I'm reading things from around the world, and I'm getting emails from members asking me whether we should get out of gold stocks. And when you start seeing and perceiving that people are starting to give up on gold, you know that you're probably fairly close to the bottom. So I'm actually pretty encouraged by that. Silver, same comments for silver as with gold. And look, oil's also very strong, but it's really gas stocks that are all the rage. If you look at the really good performers, the really stunning performers on the market in the last couple of months, they're all pretty much gas stocks, really. And that sector's getting a little bit frothy, I believe. Now, just looking at some opportunities, oil and gas, strongest sector. There's lots of breakouts. And when we get to this stage, there's quite often lots of false breakouts, and I'll show you what I mean by that in just a minute. And that's why you need to have a process to go with the information that you may be getting from the market. So for me, absolute care needed with entries and exits and trade management. Now the gold producers, this extra pullback in gold is just setting up some even better examples, and there's so many really good gold producers in Australia that are technically now, from a charting perspective, are just potentially into an area of being a really good buy, and fundamentally they're good businesses, and you know, to me they're just amazingly cheap. So the gold producers will have their day. Now the resource service companies have also done fantastically well. There's a couple of good ones that haven't moved as yet, and certainly members of Specialist Share are aware of those companies, and we're going to see some good entry points on some of the others that have already had a really good run as well. So really important not to overpay. I've seen a stock like NWH, for instance, which is in NRW Holdings, I think, and they came out with some excellent fundamental results for their half year, and the price has gone up from $3 to over $4, which is a fantastic run. But you've really got to say that it's it's well and truly overdone now, both from a charting point of view and from a fundamental point of view. It's a bit expensive, so you've just got to be careful not to jump over those guys. Okay, let's just have a look at a few charts, and then I'll pass over to you for questions. So the first one here is just the S&P index, and you can see it's just been an amazing run since the 20th of December, which was when the ECB turned on the money taps in Europe. We had a slight rollover. We got a 20-odd point down day on the 6th of March, and that's effectively been it. Now I'm looking at 1440 as the next level. So just looking up here as our next potential level. But I would think it probable that we will see another day like the 6th of March at some stage between here and 1440. I would be surprised if it just went straight there the way that it's heading. And I'll just cover gold and silver quickly for anyone that didn't have a chance to see what I wrote over the weekend, what I covered over the weekend by video. So this is gold on a big picture view. The run from the 29th of December last year to the 29th of February, that was effectively the first leg up on a bigger picture view. We're now in the second leg correction, so it's correcting. So far it's corrected almost 61.8% of that run from late December, and it's getting a bit messy. It's taking a bit longer than I would like, but I still believe that that is the situation. And I just want to make a point here. I'm not an Elliott wave devotee. I use some of the principles because they make sense in terms of crowd behavior. And I use Fibonacci levels because I find that they give you an edge, not a guarantee, but an edge. And yeah, I just think the principles that upon which Elliott wave is based is quite useful. So I'm still expecting that this second leg correction will finish probably in the near term. We're reasonably oversold now, and I would then expect a third leg, which will be quite a major leg in terms of time and distance. I would expect that to continue for quite some time, and that should be the real sweet spot. And I expect that during that phase we'll see the gold producers actually do some serious catch-up. Let's just have a look at our market. We can look at our index, but really it's academic only because it really only reflects the top 10 or so stocks on our market. And you can see how much it's underperformed the American market. It's just not funny. We had a wedge pattern formed up here. We got a false break for 2 days. It's come back now into that wedge and really needs to break above 43.50 to indicate that it's got some upside momentum. I think it's going to struggle myself because our banks, which contribute a lot to the index, have got some severe headwinds. Resources, the major resources, BHP and Rio, are being held back by fears over China, which are overdone, and you've got stocks like Woodside that are always pretty expensive, so I don't see much upside there. So frankly, I'm not expecting a great deal from our index. I'm looking very much at an individual stock level. Now, I just want to make a point about breakout patterns. Let's have a look at a couple of stocks. The first one is a stock called Drillsearch Energy, and I want to wind back to when that stock first broke out. Let's just see what it looks like when it first broke out of that trading range. So we're talking here around about November of last year. Now you can see we started to get some volume spikes, which was indicating that we had more interest coming into the stock. The smart money was accumulating, and that gives you the odds that the price will continue through to the upside. Now, there's certain things that I look for in this pattern here, but at the end of the day, you can't be sure that a breakout is going to lead to a positive trade. Now, this one did manage to continue. We got a great consistency of volume through there. Basically, when the price had a little bit of a rest, the volume went right down. There wasn't any enthusiastic selling, and the net result has been, a fabulous trade that's run from 50 odd cents, trebled to $1.50. We've had the obligatory pullback, which is good, and now we're starting to advance again. So that one worked out really, really well. Now I just need to find another stock that looked exactly the same early on, but has not actually. In fact, let's have a look at another oil stock called CVN. Now CVN is a stock that's traded up as high as 80 cents in the past, has had a meteoric fall from grace. It's had a lengthy period of consolidation, and we got a couple of weeks ago what looked like a terrific breakout. You see that was a really good breakout, lots of volume, clear candle breakout, and now the price is kind of pulled back to a disturbing degree. We had a better day today, which is good, so it's not dead yet, but it's certainly not performed anywhere near as well as Drillsearch, for instance. Now the point I want to make here is that when you're looking at these breakouts in the early stages, you cannot be sure whether it's going to be a successful trade. So therefore it's how you manage it on a consistent basis, how you get in, how you manage your risk, and how you manage your exits, and how you do it across a whole portfolio of stocks. That's really so important. So I just wanted to really register that key point today. Now that's all I wanted to cover. I'll open it up now to you guys for questions. Hope I haven't rabbited on too long. So let's see. Alrighty, now I've got a question here about NWE. Do I see it moving higher? Peter, I've got to refer you back to what I said at the start, and that is, okay, yep, sorry, I'm now reading your second question. Do I see the US dollar staying around the same level? My goodness, I really don't know. This is a technical opinion only. Now, first of all, I'll give you my fundamental opinion. You've got so many different governments around the world and central banks around the world that are actively trying to devalue their currency. Now, because currency values are relative to each other, not everyone can devalue relative to each other. I guess it's just the guys that have got the biggest money presses and the deepest pockets can maybe devalue more than others. I would see that US government policy is going to keep pressure on the US dollar, and I think the US is trying to do what China's done for the last 2 decades, and that's keep a relatively low US dollar, which boosts their manufacturing. Now the US is in a lot of trouble. The housing market has not recovered, and there's a huge overhang of foreclosures that I think are going to keep the US housing market down for quite some time. And consumer spending is kind of picking up a little bit, but it's not really that robust because people have gone into a bit of a deleveraging thought pattern now, which I think is going to be a long-term trend. The one bright spot that's coming back now in the US market is manufacturing are rehiring. They're putting jobs on, and there's been a lot of innovation in manufacturing in the US. If the US Fed and the US government allows the US dollar to rise, that is going to put pressure on one of the few bright spots they've got in their economy. And with an election this year, they're going to be doing everything they possibly can to get employment up, and particularly in the manufacturing sector. So from a fundamental point of view, I believe that the US will do whatever they can to not let their dollar appreciate, despite what they say. Now, what could cause the US dollar to appreciate is if the euro just basically falls over. So if there were some other major issues in Europe and the euro came under great pressure, then money would flow back into the US dollar and it would appreciate. So that's the wild card for me, Peter. In the absence of that, I would think that it's unlikely the US dollar probably gets any firmer than where it is now, and I think it's possible that it could even weaken off a little bit. But really, I think the market circumstances we've got are such that I'm expecting reasonable stability in the US dollar, probably an advance in the S&P 500. I would expect resources to stay fairly buoyant because the underlying supply and demand is pretty good, and if the US dollar doesn't go up, then that'll be good as well. And as I've made the point to our members on many occasions, a lot of people are saying when all this new production of iron ore comes on stream, when all this new production of copper comes on stream, that prices are going to fall over. And the point that a lot of people are missing is that there are so many delays in the supply chain that are actually preventing that. Just the pure availability of equipment to build things, to build mines, to build ports, to build ship loaders, the availability of huge truck tires. Rio was in the press a couple of weeks ago saying that they had 18 months to 2-year wait on major truck tires and key pieces of equipment. So it's things like that, not to speak of legislative and environmental delays, that are actually preventing that new supply that's unquestionably in the pipeline, but it can't actually get to market quick enough. So I'm still very bullish on the supply and demand for commodities. Okay. It was a pretty long-winded answer to a question, but hopefully that did it for you. All right, at this point in time, we don't have any other questions. So I'll leave it at that point. If there aren't any other questions coming through, and I hope this has been of value to you. If anyone would like to give us some feedback, just drop us a line to info or support at specialistshareeducation.com.au and give us some feedback. We appreciate that. We're always open-minded to what we present within the bounds that the laws allow us. Okay, and I've just got a couple more questions coming through. Okay, what software do I recommend? Look, I use Market Analyst, which I find does everything that I need. I'm a reasonably simple chartist. I don't get too complex because I find complexity only makes matters worse. It just gets you more confused. It makes the decision making more difficult. So I think most software that you could buy is going to do the job that you need to do. If you want to be incredibly complex and if you want to do a lot of electronic back testing, then you should get your hands on something like Metastock. But frankly, I don't believe that's the answer in all the experience that I've had. I believe in reading things as they are at the moment. My other answer to you would be, Douglas, that it depends on what stage you're at. I don't ever encourage new members of our group to worry about charting in the early days. What I want them to do is to get very, very clear about trading plans and entry and exit execution and discipline and all those sort of things, and not to distract themselves with learning how to interpret charts, because interpreting charts is very much a long-term skill. You've just got to look at 10 or 20 or 30 or 40,000 of them over time to start to see the patterns. So I'm always very wary about recommending, if you're relatively new to the market, that one of the first things you do is go out and get some charting. I just don't think it's the way to go. Now being asked to put up a chart here for NWE. This is the chart on NWE. I can't make any comment on it because and it really strictly is it's the laws that ASIC provide. I really cannot make a comment in this forum on that chart. So I'm sorry about that, Peter. What software do I recommend to follow and store your trades? Oh, okay. Again, look, I just use a simple Excel spreadsheet. I know you can use portfolio managers and all that sort of thing, and most of them, there's generally a portfolio manager associated with most broking platforms. I use a couple of different broking platforms. I use ComSec and I use CMC Stockbroking, which I find very good. They've both got portfolio managers, but I don't use it because my very, very simple spreadsheet does the job for me. Okay, I've got a question here about my training services. I really don't want this forum to be a promotional one, so I'm only answering this because I've been specifically asked, so I hope everybody else forgives me for that. I certainly don't want to be promoting actively here. But our training services cover two broad areas, and this information is all available on our website, Douglas. We've got services on trading, which is really about short to medium term cash flow, and we've got services relating to investing, which is really about long-term wealth creation over a lengthy period of time. Within the trading areas, we've got a service that is really more medium term, so we're talking trades that go for a month to maybe 6 months. And we've got a shorter term forum, which is what I call live trading room, which is anywhere from a couple of days to maybe a month or so, typically. The way they're structured, there is an upfront training component. There is a lot of support upfront to make sure that you've got trading plans sorted out, that you understand what you're doing. So huge effort in the front end in terms of making sure you've got your understanding right. And then the rest is ongoing provision of information, buy and sell recommendations on a daily or even perhaps hourly basis. So it's across the spectrum from short-term trading to really long-term investing, and it really just depends on what you're after. So there's a lot of information on our website, which I would direct you to. And again, if you have any other specific questions, we're always very happy to respond to those. So if you just send them through to support@specialistshareeducation.com.au. Okay, that appears to be all the questions. Hope it's been valuable for you, and we'll see you again next week. Cheers.